I think the bond market is a little bit hysterical here, but it's because of a wave of money around the world that's looking for a home, and I think that's just pushing down these yields. I don't think the inversion tells us we're heading for a recession. I think it's a bit of a broken barometer. But, there are lots of other traffic lights around which are flashing orange also. And I think what's happening is the trade tensions are catching up with the market. And I think people realize it's slowing global growth. And this uncertainty does raise the risk of recession to its highest level since the 2008 debacle. And I think that's really what's going on here.
John, usually we don't import recessions from other countries. But right now there are, I forget what article I was reading this morning, a number of major countries that are either right at the flat line in terms of growth or in negative growth. Prime among them, Germany, also Great Britain, Brazil, and Mexico, Argentina. What would the transmission mechanism be for a recession to come from overseas here?
Well, I don't think it would be based on what's happening right now. I don't think you can imply that there's a recession around the corner based on what the bond market is doing. I have to agree with David. It might in some way increase the percentage chance of a recession, and you can't help but notice an amber light on the dashboard. But relative to what the bond market is doing, this reminds me of when the bond market thought yields were going to rise in the fourth quarter of last year. If you remember, we were at what was it, 3 1/4 sometime in November, and we'd been in last year. We had a number of times the 10-year was over the 3% markers. So with other countries, you've got to look at the idiosyncratic problems within those countries as well as you have to consider what is their policy in terms of fiscal stimulus versus monetary stimulus. And usually you'll find a kind of an odd a pro and negative on that kind of thing where they're not participating. In the U.S., we've got a fiscal stimulus occurring via a relatively accommodative Fed.
Right.
Plus, the president wouldn't agree with that, but the Fed's accommodative. And you've also got good opportunity here if you take a look and you consider the position that we're in related to the trade war at this point isn't that bad based on the economic data that we're seeing.
David, let me ask you what you think is the catalyst for the last 20 minutes or so where bond yields took this fresh dive, the 10-year below 1.5%, and it's back there now, in the stock market selling off more too.
Well, it's very hard to know what moves the bond market minute to minute. It's clear the stock market is following the bond market here. But overall, I mean, this is about trade tensions. It's very difficult to actually get a global recession. There are only one or two things that can cause it. One of them is a global financial crisis, and the other one is trade, because almost every other country in the world actually exports more of its GDP than we do. And that's why it's hurting countries, particularly like Germany, Taiwan, Korea, Japan. These are big export powerhouses, and they're getting hurt by the same disease right now. So this is a particularly bad illness for the global economy, and that's what's hurting the whole global economy. It is hard for us to import a recession this way, but we're doing our best.
So you think, and there were headlines this morning. I mean, the European Central Bank, David, had an official come out, Olli Rehn, talk to the Wall Street Journal about how in September they're preparing major stimulus. Is it just markets continuing to digest that?
Well, I just want one correction. They're preparing major easing. I have no idea why they think that would actually stimulate anything.
Right.
I mean, it's absolutely ludicrous that they don't actually look at the transmission mechanisms by which lower interest rates are supposed to stimulate the economy, because all I can see them doing is undermining their banking system. It is not working, and they should stop doing that and talk to the Germans perhaps about some fiscal stimulus in Germany, which is one area where I think a government could prudently expand its borrowing, expand its deficit, given its economic position and its debt position.
John, David does not think that the inverted yield curve is an infallible predictor of a recession, but he does believe that the odds or likelihood, the risks of recession are rising, and that it is time to become more cautious. You take the other side of this argument, as I understand it. You remain overweight U.S. equities, continue to favor cyclical sectors, which would suggest a growing economy, and you think that the defensive sectors are overbought. Explain why you say stay with it.
Well, Tyler, one thing is the current embrace of defensive sectors by many investors has been going on for months now. I think for most of the year, and within the cyclical space, you've got to consider. Just suppose we get an agreement, some kind of resolution with China, and we don't propose it's going to be a heaven on earth kind of solution, but something akin to or on parallel to the SALT agreement that happened many years ago between the U.S. and the Soviet Union. This case in parallel to trade as opposed to limiting nuclear ballistic missiles. But what we think is if we get a trade deal with China, you're going to see a 180-degree turn in terms of projections and expectations, both in terms of global growth, U.S. growth.
Doesn't that feel like a big if right now, John?
I don't think so. And every day that China doesn't come to the table or can't find a point of an agreement with the U.S., what it leads to is more companies are changing their plans in terms of their trade route, moving away from the China supply chain. And when you look at that, that is a compounded effect that China is bound to recognize.
Okay.
They're very smart, and they're looking at that, I'm sure.